Hello everyone, today we will talk about the taxation. We know that taxation is very important to a business and an individual. This article will uncover the value of taxation from 5 aspects. Firstly, we will explore the different meanings such as calculation basis and purpose of both accounting profit and taxable profit. Secondly, we will delve into reasons why income tax expense and income tax payable are not same at the end of an accounting period. Thirdly, we will uncover the strategies that enable profitable companies to legally minimize their tax effort. Fourthly, we will clear why incurring a tax loss doesn't automatically translate to recognizing a tax-related asset in financial statements. Finally, we will equip you with knowledge on navigating tax rate change by considering factors like who affects it, the type of tax, and the economic climate. You will be able to make informed decisions and adjust your financial plans accordingly. Okay, let's talk about the first question. Explain how accounting profit and taxable profit differ. We can see the comparison chart about accounting profit and taxable profit. We will discuss the differences of them from 5 points. Firstly, their meaning is different. The accounting profit is calculated by subtracting all expense. It can include non-cash items such as depreciation and amortization. The taxable profit is calculated as the difference between taxable revenue over taxation deductions allowable against those revenues. Secondly, they are based on different standards. Accounting profit based on accounting standards, while taxable profit based on Income Tax Assessment Act 1997. Thirdly, accounting profit is for a particular financial year, while taxable profit is for the previous year assessed in the assessment year. Fourthly, the object of accounting profit is to know the profitability and performance of the entity. Taxable profit is for know the taxability of the entity. Lastly, the audit methods are also different. Accounting profit uses financial audit, while taxable use taxable audit. Okay, let's move to the next question. The second question is, will the income tax expense for an accounting period be the same as the income tax payable at the end of that accounting period? No, they are not the same. From the definitions of the two, we can find that their difference is essentially because one is expected and the other one is actual. Income tax expense is an estimate made during the accounting period for financial reporting purposes. Income tax payable represents the actual amount of tax owed to the tax authority at the end of the period. This amount can differ due to factors such as timing difference, changing in tax laws, and tax plan strategy. Specifically, income tax expense is an accounting concept that represents the estimated total amount of income tax that a company expects to earn for the entire financial year based on its financial statement and applicable tax rates. It is recorded on the company's income statement as an expense, which reduce the company's net income for that period. Income taxable expense is calculated using accounting principles such as the accrual method, which recognizes tax based on the revenue earned and expense incurred during the accounting period. On the other hand, income tax payable is an actual amount of income tax that a company owes to tax authority at the end of the accounting period, often referred to as a tax liability. This amount is determined based on the company's taxable income for the year, applicable tax rates, deductions, and tax credits. Income tax payable is a balance sheet item and represents the company's tax liability that need to settle in the near future.
Yes, so today I will be answering the question 4. Would incurring a loss for the tax purpose lead to the recognition of the tax-related asset in the financial statement, and why? So in general, tax losses do not result in the financial statements recognizing a tax-related asset. A business experiences a loss for tax purposes when its taxable income is negative, meaning it's earned less in tax or none at all for the current period. However, the idea of recording the tax-related asset in the financial statement usually related to the circumstances in which the business has already overpaid the tax, or it has the tax credit or the transitory differences that are deductible and would reduce the future tax advantage. So a deferred tax asset arises when the company has overpaid the tax or has a tax deduction or credit that it can be used to offset the future taxable income. However, if there is uncertainty about whether the company will generate sufficient taxable income in the future to utilize the deduction or the credit, then the deferred tax asset may not be recognized. And finally, incurring a loss for the tax purposes might indicate that the company has already utilized its tax deduction or the credit to reduce its taxable income to zero, or it doesn't expect to generate sufficient taxable income in the future to utilize them. In such cases, recognizing a tax-related asset would not be appropriate because there is uncertainty about the realizability. Thank you.
Understanding how accounting profit differ from taxable profit and income tax expense from income tax payable empower informed financial decision, optimizing tax strategies through deductions, credits, and planning helps minimize liabilities even for profitable companies. Recognizing tax asset depends on future reliability, while adapting to tax rate change requires considering various factors. In conclusion, a nuanced understanding of tax-related concepts is vital for successful financial management and compliance. Thank you.